The dream is everywhere on the internet. Build a dividend portfolio. Collect checks every month. Never work again. $5,000 per month in passive dividend income. It is a genuinely appealing vision. And parts of it are real. But the path from here to there is significantly longer, the math is significantly harder, and the strategy is significantly different from what most dividend content creators tell you. Today we are going to be completely honest about dividend investing, the real math, the real tax implications, the economic theory behind dividends, and the specific cases where a dividend focus actually makes sense. Let us start with the $5,000 per month target that appears in so much dividend content. $5,000 per month is $60,000 per year in dividend income. How large does your portfolio need to be to generate $60,000 per year in dividends? That depends on the dividend yield of your portfolio. The S&P 500's current dividend yield is approximately 1.3%. At that yield, you need $4.6 million to generate $60,000 per year. Almost nobody in the dividend content space mentions that number. If you tilt toward higher-yielding dividend stocks and ETFs, let us say a 4% yield portfolio, you need $1.5 million. That is more achievable, but still $1.5 million. For a 25-year-old investing $500 per month at 10% returns, that takes roughly 32 years to reach. Not next year. Not in 5 years. 3 decades of disciplined, consistent investing. The $5,000 per month dream is real, but it requires either $1.5 million in capital at 4% yield, $750,000 at 8% yield, or a very long time horizon of consistent investment. Understanding which of those is true in your situation is the starting point of an honest conversation. Here is the math that dividend content creators consistently omit: the total return comparison. Total return is the combination of dividends received plus stock price appreciation. When you focus on dividends specifically, you are implicitly making a trade-off. You are selecting for income today at the potential expense of growth tomorrow. High dividend stocks, think utility companies, REITs, tobacco stocks, often have limited price appreciation. Their companies are mature, slow-growing, and in some cases declining industries. They pay high dividends because they have limited profitable reinvestment opportunities. Returning cash to shareholders is better than investing it internally. That is not a sign of strength. It is often a sign of limited growth prospects. Conversely, the companies that have produced the greatest long-term wealth, Amazon, Alphabet, Meta, Nvidia, for much of their history, paid little to no dividend and reinvested capital aggressively into growth. An investor who avoided them because they did not pay dividends missed the decade's best compounders. The academic research on this is clear. From 1927 through 2020, dividend-paying stocks as a category have underperformed non-dividend-paying growth stocks in total return. The premium for growth has historically exceeded the premium for income, particularly for investors who are in the accumulation phase of their life cycle and do not need current income. In 1961, economists Franco Modigliani and Merton Miller published what became known as the Dividend Irrelevance Theorem. It is one of the most important and most ignored insights in finance. The theorem states, in a perfect market, a company's dividend policy does not affect its overall value or its shareholders' total return. Paying a dividend is economically equivalent to not paying a dividend. Here is the intuition. When a company pays a $1 dividend, its stock price drops by approximately $1 on the ex-dividend date. You receive $1 in cash, but the value of your share is now $1 lower. Your total economic position, share value plus cash, is identical to what it was before the dividend. You did not receive free money. The company transferred value from the stock price to your bank account. This is why the famous saying in finance is that dividends are not income, they are return of capital. You are receiving your own money back. The real-world implications of dividend irrelevance: a company that pays no dividend and reinvests that capital at high rates of return creates more shareholder value than a company that pays it out, assuming the reinvestment opportunity is genuinely profitable. A company that pays dividends because it lacks good internal reinvestment opportunities is not being generous with shareholders. It is being honest about its limitations. Dividends have a structural tax disadvantage relative to capital gains that most investors underestimate. Qualified dividends, dividends from U.S. corporations held for more than 60 days, are taxed at the long-term capital gains rate, 0%, 15%, or 20% depending on your income bracket. That sounds reasonable. But here is the problem: dividends are taxed in the year they are received, regardless of whether you wanted the income or not. If you hold a high-yield dividend ETF inside a taxable account, you pay taxes every single year on dividends that are automatically reinvested, money you never saw in your hand. Contrast this with a growth stock or growth-focused fund that pays no dividend. The capital appreciation in that account is not taxed until you sell. That capital gains compound untaxed for decades. You control when the tax is triggered. Over a 30-year horizon, the difference is significant. Taxes paid annually on dividends cannot compound further, they leave the portfolio permanently. Taxes deferred on unrealized gains compound inside the portfolio until you choose to sell. The mathematical advantage of tax deferral is equivalent to an interest-free loan from the government for the lifetime of your investment. Dividend investing in a taxable account systematically destroys this advantage by triggering annual tax events. If you are going to hold dividend-focused investments, hold them inside tax-advantaged accounts, your IRA, Roth IRA, or 401k, where the dividend taxation is either deferred or eliminated entirely. Despite all of the math above, dividend investing does make sense for a specific type of investor. The retiree, or near retiree, who needs reliable, predictable income from their portfolio. Here is why. In retirement, the sequence of returns matters. If the market drops 40% in your first year of retirement and you are selling shares to fund expenses, you are permanently locking in losses. This is called sequence of returns risk, and it is one of the greatest threats to retirement security. A dividend-focused portfolio partially mitigates this risk. Dividends from high-quality companies are generally more stable than stock prices. A company paying a $2 annual dividend might cut it by 20% in a bad year, but the $1.60 still arrives while the stock price might have fallen 40%. You are not forced to sell depressed shares to fund expenses. Psychologically, many investors also find it easier to live off dividends than to systematically sell shares. The framing matters. Spending dividends feels like income while spending principal feels like depleting wealth. For investors who are behaviorally prone to overspending in retirement, a dividend focus can serve as a useful mental constraint. But this is a retirement income strategy, not a wealth accumulation strategy. For investors under 55 who are in the growth phase of their financial life, chasing dividend yield is almost always a suboptimal approach. If you are going to include dividend-focused investments, either because you are near retirement, because you want income, or because the psychology works for you, do it with high-quality, diversified ETFs rather than individual stock picking. The two best options in the space are VIG and SCHD. VIG is the Vanguard Dividend Appreciation ETF. It focuses on companies that have increased their dividends for at least 10 consecutive years. Current yield is approximately 1.8%, not high, but the companies in the fund are high-quality, growing businesses: Microsoft, Apple, United Health, JP Morgan. The total return of VIG over the long term has been competitive with the broad market because dividend growth implies business quality. SCHD is the Schwab U.S. Dividend Equity ETF. It has a higher yield, approximately 3.5%, and selects for companies based on dividend consistency, cash flow coverage, and dividend growth history. It skews toward sectors like financials, consumer staples, and healthcare. Total return has been strong relative to its yield category. Both are better than the typical approach of picking 10 to 20 individual high-yield stocks, which concentrates your risk dramatically and requires ongoing research to monitor for dividend cuts. If you want the full market with dividends reinvested automatically and no sacrifice to total return, the simplest choice is a broad S&P 500 or total market index fund in a tax-advantaged account. Dividends reinvest automatically, you avoid the tax drag in taxable accounts, and you do not sacrifice growth by tilting toward yield. Here is the final framework for thinking about dividend investing honestly. If you are in the accumulation phase, under 55, primarily focused on building wealth, total return beats dividend focus. Use broad index funds, minimize tax drag, let growth compound untaxed as long as possible. If you are in the distribution phase, retired or within 5 years of retirement, dividend income has real value as a buffer against sequence of returns risk. A VIG or SCHD allocation alongside total market funds is a legitimate strategy. If you are psychologically motivated by income, if seeing dividends hit your account makes you more likely to stay invested through market downturns, dividend investing serves a real behavioral function even if the pure mathematics do not favor it. The best portfolio is the one you actually maintain. The $5,000 per month dream is real. It requires $1.5 million, a long time horizon, and a clear-eyed understanding of the tax and return trade-offs involved. Build the portfolio first. The income follows the capital. There are no shortcuts. Word count, 1, 300 duration, 10-minute end card. Next video, she built a $500,000 portfolio on a teacher's salary in 14 years.